Hello and welcome to our second edition in our trilogy. Welcome again to Rena Poppert, my guest expert from the legal world. Hi, Rena.
Hi, Rob. Thank you for having me.
Brilliant. And Rena, if you haven't seen the first episode that we recorded, Rena is the owner of a brilliant law firm based in London called Carter Bond Solicitors. And Rena and I have worked together for many years. In fact, I did say in yesterday's episode that we'd had a cumulative 30 years of selling businesses, but I suspect it's actually probably nearer 35 plus.
I think it is a bit more actually, Rob.
Yeah. Okay. So we're knocking on our Ruby anniversary between us, 40 years maybe. This hour is dedicated to you, the watcher, the listener, the person who's tuning in, to help hopefully equip you for selling your business for a top price at some point down the line in the future. So let's activate the screen. So a wee bit of a recap. The purpose, twofold really. We do want to, the whole purpose of doing this is to prepare business owners, not in a particular country, the information, the knowledge and general truths sometimes are universal, regardless of where you're listening from, which industry sector you're in and how large your business is. The second purpose of this course that we're partway through now, we're going to explain the business sale process because there's a lot of myths and a lot of misunderstandings from business owners. They've heard bits, but they don't know how it all hangs together. So we're going to clear the waters on that one, clear the mists, and give you some real clarity on the business sale process and the things to avoid if you want to sell your business for a top price. So those are the twofold purposes of the course. Previous session number 1, you can see the things we covered. Not going to run through that list. You can see it for yourself there. Some of the, there was some real food for thought, wasn't there, Rena? Particularly the questions that came after in the Q&A.
Yeah, we had some excellent questions. So keep them coming as well, and we'll answer them at the end of the session. But some great questions.
There was, and I will renew my offer yesterday. This will come from me rather than Rena, unless she wants to chip in. A bottle of champagne for the person that stumps the experts on this session. We're looking for your trickiest questions, as well as obviously ones where you genuinely want to find out the answer to a question or need some guidance in a specific situation you've got. And I will say that one of the things that you can have is a copy of my book. Well, I don't know why I'm holding it up, because I've got loads out there waiting to go out from people who have registered for the course. The 11 Commandments and 7 Cardinal Sins of Selling Business. That's 20 years experience condensed in about 170, 180 pages. So if you're listening to this course and you'd like a free copy, then just pop me an email. Okay, so more to do with this session today. What are we going to cover in session 2? There are a variety of exit options, not just 1, not just 2, but as you'll see there, 10. I'm going to talk a bit to the principle of the value proposition. Anyone that's involved in marketing will understand value proposition. It's the same in M&A, and we're going to unpack that one for you today. Common question is, how on earth do you find buyers for my business, and where do I start in terms of an approach? So we're going to lay that out for you. And then, as Rena mentioned, we're going to have a live Q&A. We do that after every session, really as a wrap up to answer any specific questions that you've got. I've had a couple of overnight, so they get priority. And there was one from yesterday's session, wasn't there, Rena? A chap called Gary that asked about identifying buyers. Well, there you go, Gary. It's actually on the agenda. So we'll cover that today for you. And session 3, the next session, just to whet your appetite, we're going to cover competitive tension, surviving due diligence, something that Rena knows all about because she orchestrates it for her clients who want to sell the business or buy a business or raise investment funding and any combination of the above. And I'm going to talk about life after sale because I sold up last year. And it's good to get first-hand experience from someone who's been there, worn the T-shirt and gone through it. And then again, next session, we'll have a live Q&A as well. And something I said yesterday, there's 3 hours of content when you add it all up. Once you've listened, thought about it, you've got a choice to make in your life. You can either do something going forward, or you can do absolutely nothing. But that's your decision, it's not ours. Our responsibility is to unpack things and provide information and knowledge that help you on your journey to selling a business, whether it's this year, next year, 5 years' time, 20 years' time, doesn't matter. The principles remain the same, regardless of your timescales. So, exit options. We're going to talk these through, Rena, together. So, first one, a full exit, 100%. You sell it lock, stock and barrel. But there are two ways a sale can happen, two basic legal ways, aren't there, to sell a business. You can either sell the equity or you can sell the trade and asset. So just want to sort of talk to that piece, first of all, Rena, just to sort of set the scene.
Sure. So you can sell actually the business and assets, so it's a goodwill in the business and assets, or you can sell the shares. Now, there's pros and cons depending on if you're selling or buying as to which way to do it. In short, when you are selling the assets, the buyer is cherry picking what they want. So they're taking all the good stuff, all the assets are the good stuff. For example, any licenses, any consents, they're probably taking the lease or the property, they'll take the employees, and they'll take the goodwill, the equipment, etc. And they'll leave behind all the liabilities. So as a seller, you're then left with this company which has got the liabilities. Now, usually the sellers will liquidate it, so all the liabilities and fall away with it. Or the sellers can sell the shares. And the beauty of that is, I mean, I'm not a tax expert, but you do get entrepreneurs relief with that as a seller. And there's different tax benefits, for example, the cash extraction, if you've got surplus cash in the business and so on. Essentially, when you're selling the shares, you're selling absolutely everything. So the buyer steps into your shoes as the seller. So you've got nothing left afterwards other than hopefully a big pot of money.
Yeah, I had a call a couple of weeks ago, Rena, and the buyer with their advisor, who's an interim FD. In fact, it was the interim FD that suggested this. They said, a client, or my client, is looking to just sell assets in the business, not the business itself. What he meant was equity. And I said, why? And the interim FD said, well, we make a much smoother due diligence process. There's less to do, should be a far quicker deal. I said, well, what about your client? I'm trying not to mention their name. What about your client, who's on the call as well, being left with on the hook for all sorts of liabilities in the future? And he said, what liabilities? I said, well, I don't know, issues with tax, issues with product warranties. You tell me what might come up over the future. So there's an example of where you can sell the bits and pieces to someone within the company, but you still retain the ownership via the shares in the business. So you are on the hook, aren't you? I did advise them correctly today.
You are. So you're actually, if a seller sold just the assets and not the shares, then they're ultimately still the shareholder of the company, which has sold all the good stuff and is left with all the liabilities. So you've still got to pay the tax and the VAT and anything else. And then you've got to liaise with your accountant and advisors to try and wind up the company properly so that there's no comeback. Because remember, if you just go to Companies House and press dissolve and fill out the form, then actually that can be resurrected. So the company can be resurrected within, I think it's 6 years or 7 years, whatever it is. And so if there was going to be a claim against you, then somebody can still bring a claim against the company. So you'd have to make sure that if you're selling the assets, that you've got this company and you're still the shareholder, that you then dispose of the liabilities and the company properly, so winding it up, etc. And then that incurs more costs because you need the insolvency practitioner to help you with that, etc. So yes, the buyer can, get around the due diligence quickly, but remember, as a seller, you're left with the company and you're going to have to do something with it, and probably spend some money to do something with it to make sure that you can dispose of your liabilities properly.
Brilliant. Top tip there, really. So if you're looking to sell your business, sell the shares generally, yes. Unless you have to, unless it's a distressed business and you don't have a lot of choice because it's going into insolvency. But if you've got a solvent, ideally profitable business to sell the shares. Make a clean break from your business rather than having this hangover, which is going to cost you more time and money down the line. So thanks, Rena, for that one. Variation on a theme. Partial exit. So that's where you sell a proportion of the equity in the business. Similar rules apply, really, don't they, Rena?
Yeah, I mean, as a seller, the ideal position is you want all of the money on completion on day one, and then you're off, and it's up to the buyer. Now, reality is slightly different, because a buyer, as hopefully you found a buyer who's paying the premium price and etc. And the buyer is going to say, great, Mr. Seller, we'll pay this based on all the financials. However, we're not going to pay it all up front. We're going to pay 70%, 80%, etc. on day one, and the rest is going to be deferred. Because if you say that the company is this great and it can do this level of profits and turnovers and etc., well, then prove it. And the way that's usually done is by what you call an earnout. And the seller remains as either a director, as a minority shareholder. It just depends on the structure that's agreed. But the seller's still involved in the business post-completion. And the reason for that is the buyer said, we're going to pay you a proportion post-completion, and that's linked to an earnout, linked to the business reaching certain targets and profits and numbers. And from a seller's perspective, you want to be able, as a seller, to have some sort of control over those figures. Because if you just give everything up and say to the buyer, continue running it as I run it, and yes, you'll hit these figures, well, you don't know how the buyer is going to operate the business post-completion. So the seller will probably retain some of the shares and probably remain as a director or employee or whatever it is, to make sure that the business continues doing what it's doing to achieve these figures, so that the earnout targets are met, which means then that the seller is then paid on year 2, year 3, or whatever's been agreed. So unfortunately, from a seller's perspective, it's not always the case that you get the lump sum on day one and it's happy days. There will be a period of an earnout or some deferred consideration, and that's where that's what we mean by a partial exit.
Yeah, and just to build briefly on that, it could be that you, as the current owner, just wants to sell a minority stake in your business. A lot of business owners find it very hard, don't they, Rena, to let go of their treasured asset, which they often see as a child because they've given birth to it, nurtured it and grown it. And that's totally permissible. Why would you want to sell a minority stake? Well, maybe to bring in an investor, another business, another individual that can add value to you going forward. And together you grow the business. So you don't have to sell it all. Management buyouts, the difference between a management buyout and the next one, management buy-in. A management buyout is someone within the current business buys you out or part of your shares out, so you dilute. Typically, that would be senior management team that are looking for a stake in an equity stake in the business. So that's a management buyout. A management buy-in is where someone external from the business buys equity into the business. So that's someone new into the midst that buys their way in. Something, the new kid on the block, employee ownership trust. I don't know, have you been involved much with EOPs at all, Rena?
They're becoming more popular now, I think, than before. And that's where the employees have some sort of ownership on there, but it's the documents are drafted very, very carefully, so they are owners in the business whilst they're still employees. And what that does is it gives some incentive to employees to then perform as well. And the exit being that either there is a management buyout, which is the ideal, or worst case scenario, if you had to let them go or if they left, then those shares and ownership come back to the company or to the other owners.
There you go. I think it's an interesting one. It doesn't fit the model that I've worked with for the last 20 years, which is to create a number of bidders for a business and then improve price and terms using competitive tension, which we'll cover in the third session. But I guess it would work if there was interest from employees to buy the business from you as the current owner. Then why not put them in the pot and the pool with other interested parties as well? That way you can drive up price and improve terms for yourself. But if you want to watch that, EOTs, I've just noticed EOT and EOP. I would imagine that's a typo in the brackets, but I will check. IPOs, I've got that one right. Initial public offerings, flotation of the business. It does come up sometimes when people say to me, oh, I'm looking to sell, but I'm looking to float the business in the next 2 or 3 years. And then I mention what the minimum fees are for floating on a stock exchange somewhere around the world. And that tends to put most SMEs off. But it can happen, and it does happen, but it's not very common in my experience. But it is an option. This doesn't happen very much in the UK or the US, where I've worked and operated in M&A. Does happen more in the Middle East, where I've worked, and also in Turkey. And that, in fact, that was really hard a number of years ago, setting up an M&A practice in Turkey, because the tradition and the culture is not to sell your business, it's to pass it on down through the family. Unless, of course, it's a big global company that's interested in this family business. And then their viewpoint changes somewhat, but it was very hard in Turkey to set that up. There is, of course, you mentioned about winding up businesses. I mean, you can just step down from office and let the management team run the business, or you can step down from office and close the business. I mean, 2 different routes there that you can use. I often find, though, I don't know about you, Rena, that most business owners can't let go of the running of their business, even with their trusted senior team. And so they always seem to meddle and interfere, even though they're supposed to have gone part-time or semi-retired. Have you found that?
Yeah, it's about this word control, isn't it, when some of the business owners, and I think, yeah, I'm a victim of that. So, yeah.
I think particularly if you're a founder of a business, and particularly, you know, if you're a micro business, there's just you, which I've been in that situation on more than one occasion.
Yeah.
It becomes part of your DNA. So it's very hard to change. I did mention this just a moment ago, winding up. And you mentioned it, Rena, and you can just wind up the business. You can switch the lights off, close the door, and then go through the legal process of winding the business up and selling what remaining assets there are in the company. You don't need to sell it to anyone. You can just wind it up. Now, for the people who are very good at maths, or the accountants or the FDs, you'll notice that I've got 9 exit options. There is a 10th. You can do this. And sadly, 13% of business owners, that's what happens. Either they die or they get seriously ill and they can no longer continue. So that is a not insignificant statistical probability, well, certainly for 13% of business owners. Clearly, I'm not recommending the 10th. There's plenty of others on the left-hand side of the screen. What I would encourage you to do, listening to this, is take matters into your own hand rather than let life unfold. But sadly, a number of business owners get caught out. They die. And I've actually worked with a number of other halves of owners that have died, and then they found themselves, they've inherited the shares and they've inherited the business, and it wasn't the plan.
Yeah.
So having a succession plan is essential, but we haven't got time in this session to go through succession planning, but I just flagged that one up. So those are the 10 options. I don't recommend the 10th one at all. So value proposition. So marketeers, you'll be familiar with this. When you're thinking about selling your business, try and put yourself in the shoes, the moccasins, if you like, of the other person, the people that are going to be looking at your business to purchase it. Part of your thinking is coming up with what you're not selling, because you're not selling everything. Even if you might be selling 100% of the equity, you're not selling everything. One of the things you're not selling is you, because most owners want to leave. The last time they had a boss was 30 years ago, and they're not going to start anytime soon. But decide what you're not selling. And as an adjunct to that, do avoid, when you're speaking with buyers, talking about yourself. It's very hard. When an interested party asks you to describe the business and why you're selling, it's very easy to keep saying, I. We do it subconsciously. Train yourself to keep talking about we, talking about the team, because you're not going with the business, probably. Avoid words like goodwill, and avoid comments like the business runs itself, because nobody believes that. There's no such thing as a myth of passive income. No such thing. In fact, it's the reverse. Rena's just mentioned it, a control aspect with most business owners. The business doesn't run itself. You are actively involved in the business, and no one's going to believe it if you say it. And I do hear this quite often, and particularly read it in sales prospectuses. We are the world's leading blah, 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 blah. It's funny how everyone is the world's leading. No one's second or third or in the top 10 or the top 20. So do rehearse before you go into a negotiation meeting. Do rehearse with your advisor or a close friend or a business associate what you might say to some of the key questions that you anticipate coming up. So there's a whole series of little tips there. Value proposition. What I mean by that is, what are you selling? Why are people, and that's quite a hard thing. Most business owners I've ever spoken to find it quite hard to articulate the things. They might talk about the balance sheet. They might talk about the client base. And then they start sort of looking up, their eyeballs are looking up to the ceiling and thinking, what else? What? Oh, I've got staff, but you can't sell staff. Well, you can actually, because they come with the business. I often have to get business owners to think broader than just the immediate what's in front of their nose. So here's some things, if you're looking at why you're different. Scarcity. Are there any barriers to it? Well, how many suppliers of what you do and offer are there in your area, country, continent, worldwide? Occasionally, I sold a quarry. There was only 3 quarry companies in the UK, and they were one of them. That's scarcity. Barriers to entry. If I wanted to compete with your business, what would stop me doing that? It might not be intellectual property. It might not be patents and that sort of thing. It could be it's just really expensive to set up a business. You might need qualifications. You might need accreditations. It might be, if you're in the software, it might be that you've developed proprietary software. How long would it take someone entering your market to replicate that, or maybe improve on what you've done? How many years would that be? So that's what I mean by barriers to entry. Are there any others that sort of come up, Rena, in your experience, the sort of barriers to entry? Have I covered it?
It's just to summarize what you've said. I think it's more about what is your USP? What makes you different to a buyer? And what kind of comes to mind is almost Dragon's Den, is when you're pitching And the dragons kind of say to you, well, I could replicate this, or I could do this myself, or somebody else could do this. So what actually makes your business that bit different to a buyer to actually say that there is some value in this? And also the vision which you're selling to the buyer as well. Yes, you're selling the business as it is now, but what's the vision for the future which you're also selling?
Yeah, I love it on Dragon's Den. I think it's called Shark Tank in the US for our US watchers here. I love it when someone like Deborah Meaden says, so, right, so you're saying you've got a unique product and no one else offers it worldwide? Correct. Well, I've got one in my home. I bought it 4 years ago. So it's exactly the same thing. So you have to be very careful about saying that you've only got the one, or you're the only one in the whole world that's got this or developed this. So yeah. Like a loyal client base, I mean, that's fundamental for an acquirer. They want to make sure that your customer base is sticky. But what about your client base? Is it blue chip? How diverse is it? Have you got 1,000 clients rather than 4 that make up total turnover? What are the payment terms? Are they good payers, your client base? What's your bad debts looking like? Is it very healthy? With your charging structure, do you take an amount on deposit up front before you start any work or deliver something? So think about those areas as well. These are things that are to do with your value proposition. What is it that you're offering to a potential buyer? Mentioned about staff. You're not selling staff in individually, but as a workforce you have. And I know, what about your team? How talented are they? Do they need qualifications to do the work that they do? I know some areas of pharmaceutical. The reason for buying some businesses in the pharmaceutical industry is it's very hard to get the appropriately qualified staff for something. So they buy a business in order to get those staff on board within their group. So what is it about your team that makes them talented and attractive? Have a look at your churn rate of new staff. How many of your staff, how much of your workforce percentage-wise has changed in the last 3 years? Is it very low? What does that indicate about staff morale if it's a low churn of staff? So you see what I mean? It's thinking wider. These are the things, some of the things that will capture the attention of a buyer. Profit margins, net, I'm usually talking about net margin, but it could be gross profit. How does your profit percentage sit with your competitors? If you've got a particularly high net margin in the business, that could be really attractive to a buyer, particularly if they come from your sector, because they might be looking to learn your best practices once they've bought you, your best practices as to how they can improve their net margin in their own business, the company that's buying you. Brand and reputation is often mentioned, but what is it about your brand and reputation? What's your repeat buyer rate? So by that I mean, last year, how many of your purchases were made by people who've bought from you before? There's a percentage there, a ratio. If that's high, if it's 70, 80, 90%, that says something about the stickability of your client base, something I mentioned a moment ago. It's easy to mention about brand, but that's an amorphous concept. What is it that that brand does for your business that makes it attractive for sale? Definitely some financials. Most buyers want a healthy cash flow. No one likes to have a business that's lumpy financially, because that's what they call squeaky bum time. Often if you own a business that's very tight on cash flows. And often when valuing a business, one of the factors that buyers and accountants on the other side look at is sustainable earnings. If you've got a business that goes up and down quite regularly, how sustainable are those earnings going forward? And how sustainable are those earnings going forward when you've left the business? Is there a negative impact on you exiting stage left in terms of the financials? An attraction for many buyers is what products are coming down the pipeline. Now, you've got to be careful with this, haven't you, Rena? Not when you're in a negotiation meeting, if you're selling, not to give away the family silver, almost, by telling them lock, stock and barrel what product development is in the pipeline. How would you advise people handle that in a meeting with a buyer?
Handle the which bit, Rob?
They've got product innovation development. So these haven't gone to market, but they're things that they're working on right now, research and development and that sort of thing. It's good to talk about those things, but you can say too much in a meeting with a prospective buyer. Any guidance you'd give as to how much to say, what not to say in meetings like that?
I mean, it's a balance, to be honest. You want to say enough so that the buyer's interested, and the buyer can actually buy into this idea of the new products and services and, you know, the R&D side. But at the same time, you don't want to say too much where they know so much about your business that they're going to go off and do it themselves. So the easiest way around it is for them to sign an NDA, a non-disclosure agreement, a confidentiality agreement. And that has to be very carefully drafted, because you can say, well, we're going to tell you about this product, but don't tell anybody else. But by saying that, you've already told them about the product. So it has to be drafted very, very carefully to say that it's not only about the products and services, but anything around that subject as well, or any other information that the seller gives in relation to this new product or innovation, which must be kept confidential for the buyer only, the buyer's advisors only. And if the buyer wants to disclose it to anybody else, they've first got to get your prior written consent. And in case the transaction didn't happen, so the buyer then pulled away for whatever reason, we didn't complete, or you didn't complete to sell your business, then what happens to that confidential information, which is now already in the hands of the buyers and their advisors? So the NDA will deal with how they can deal with that, how they must handle that information during the process, but also what happens to it afterwards as well, in case the transaction didn't go through.
Yeah, no, I think that's sound advice, Rena, and also just be careful. It's a general principle, really. When you're sharing information with an interested party, it's about building a bit of trust, isn't it? And whether the buyer has actually got the funds, got the motivation, and the desire to complete the transaction. So over a period of a number of months, you start to build trust, don't you, between buyer and seller. And particularly in due diligence, these sorts of questions will be revisited. So, but you've got to be careful. Don't assume they're as honest as you. Intellectual property, do you have patents? A 20-year stay-out period is a patent, or up to 20 years. Those sorts of examples of intellectual property, like patents, design rights, etc., they are worth their weight in gold. Yes, there is a cost. We did cover that in the previous session. There is a significant outlay, not necessarily trademarks, that's quite modest, but certainly on the patent end of the spectrum, it's significant investment. But if you're looking to sell one day, that really could be your ace that you've got. So that's not an exhaustive list, but that's just to get you thinking, those 8 key areas of trying to formulate where your value proposition is when the time comes for you to sell your business. And that's the overriding statement that I would make. Start from the people. Why do clients or customers buy from you? If you don't know the answer to that question, go and find out. You should know. And it's about regularly communicating with your clients and finding out how the service is being experienced, your service that you're delivering is being experienced by them as the end user. You should be doing that anyway in terms of good customer care. But when you come to sell business, some of the principles as to why people buy from you could be used in the sale process of your business.
Can I just touch on the IP bit, Rob?
Go on then, yeah, I've just flicked it back for you.
Yeah, sorry, that's really, really important, because I see it on the flip side as well, where the business has been trading for such a long time, and naturally it's got goodwill in the name and in the brand and etc. And suddenly they receive a letter from another business which is set up, it's just a similar name by coincidence or whatever it is. And they've actually sent a letter to our clients to cease using that name. And we've tried to argue that we've been using it for a long time, we've built goodwill, etc. And the long and short of it is that it's not about who's been using the name the longest, it's about who protects it first, is the long and short of it. And also who's got deep pockets to then fight it as well, if that's how it works. So it's really, really important that if you are looking to sell, that you've protected your brand, your logo, your name, and it's registered. And once you trademark it, it's protected for 10 years. So you don't need to worry about it.
There you go. Another top tip. Thank you, Rena. Yeah, this was Gary's question from yesterday, if you remember, Rena. How do you identify people to buy my business? And I've just expanded that a bit. And how do you approach those people? So it's the research and approach. One key question I've always asked clients, former clients, is before we go into how to identify and approach potential acquirers, let me ask you this question as the person looking to sell your business. If you weren't selling, but you were buying, who would you buy and why? Because the answer to those two questions will give you an indication as to where the areas you should be looking for a potential buyer. Because if you would buy them, they may well want to buy you, because there's a good strategic reason 1 and 1 could equal 3 for both businesses. So that's the starting point. Put yourself in the shoes of an acquirer. There's a big discussion always with new clients that are looking to sell. How far should the research go? There are several communities or several areas to look. Most clients I found think quite narrow, it's quite blinkered. They think about potential competitors in their industry. That is definitely an area to look at. The trouble with going to competitors, and how do you define a competitor? I'm talking about direct competitors, is that whilst on paper they could be a very good fit, there's an issue of confidentiality, because you're going to be giving them a lot of information about your business, how it ticks, and commercially sensitive info at some point in that process. So I found that actually when most clients hear that, they think, no, I'd quite like to look elsewhere, first of all, for a potential buyer. And the complementary community is brilliant. So complementary, I mean, any company or anyone that offers different products and services to you, but sells to a similar client base to yours. So if they bought your company, what they would be doing is diversifying and broadening their offering to a very similar market. So complementary tends to be the route in, really. You can always use the competitors towards the end of the process when you've got some wonderful offers on the table from the complementary sector, and you can go to your biggest competitor and say, look, you've got a week because I'm about to sell to someone who's coming into the market. But I'd like, out of courtesy and out of goodwill as a competitor, I'd like to give you the opportunity to buy the business before someone else does. Something like that. Something soft and less adversarial, maybe. Top tip from me, 50 plus prospects. Don't think, I have mentioned that one buyer is no buyer in the previous session. If you've got someone that's interested in buying your business, don't assume that you're going to sell to them. They could be on a fishing trip, number one. Number two, if they're not on a fishing trip, they may decide, having wasted months and months of time, of your time and a lot of information, and brought in your accountant to bring the financials and whatever, and maybe a lawyer, if it's later in the process, they just fall away from the process. It's beholden on you. It's your responsibility as the seller to create a competitive marketplace. And I've found from 20 years of doing this, that number needs to be at least 50. You need to find at least 50 companies, home and abroad, or potential buyers, and approach them all individually. And that takes time. And if you haven't got the time, you need to bring someone in to do it on your behalf, an experienced M&A advisory firm. Ooh. Is there anything else before I flick onto that next screen permanently?
No, I'm sorry.
You want to add?
Yeah, I was actually just going to say that it's great to have as many prospects as possible. And as Rob said, that does take a lot of time. But with the right advisor on board, you'll create that competitiveness between them as well. And that's how you start to drive the price up as well. And then you can sift out very, very quickly those who are on a fishing expedition, or those who just, aren't very serious or don't have the money as well sometimes. But that's where you get the right advisor on board who's got experience to take that away from you so you can continue with the business.
Yeah, or it could be. I found one thing that often happens is the prospective acquirer is relevant, well-funded, could be a really good fit, just the wrong time for them. Maybe they've got another acquisition. Maybe they want to spend funds elsewhere on something else in terms of growth. So yeah, go broad initially. It's a sales, anyone in sales will understand the sales funnel technique. Go broad initially and narrow it down. Okay, how to identify ideal buyers. We had Albert Einstein yesterday, didn't we?
We did.
We always quote Albert Einstein. The other thing in a presentation is to quote Latin. And being a lawyer, well, many people, even if they're not lawyers, will have heard of caveat emptor, buyer beware, particularly with second-hand cars. Caveat emptor. I don't know whether you knew, there is something else. More Latin. What did the Romans ever do for us, apart from give us a language? Cave emptoris, which is beware of the buyer, Rena. which is the antithesis of caveat emptor. If you're selling a business, beware of the buyer. They may not have the money. They may have gone on a course where they've learnt that they can buy a business with no money down and for £1. No business I've ever sold in the last 20 years has sold for £1. It is possible, but it's not a space that I've ever occupied and never want to.
Do you see that? I've done it either, to be honest. I've not bought or sold a business for £1, and but it can be done, but I've never done that as well.
Yeah, beware of the buyer as much as buyer beware. So you get Latin as well in this presentation. Also, you see the logo on the trainers. That's my logo.
Yeah, yes, I can. Yeah.
Nice bit of branding. Anyone want to buy some shoes? And talking of shoes, tire kickers, just developing that theme. Do you know what? There are people out there that are going to waste your time and money. Sad but true. And a good M&A advisor will pre-qualify those characters out. But here's a few common traits to identify a probable tire kicker. They don't have the money, which is why they want to buy you for £1. And they don't have access to funding. So you do want to find out, if you're selling your business, some indication of proof of funding. It's easy with the larger companies, particularly if they're a PLC, you'll know exactly what their financial position is. Very much harder with a private company and a private individual. I've had this over the years. They're often very vague about what they want to buy. They'll say any sector, any size,
yeah,
any country. They may be a genuine buyer, but then again, they might just be not a genuine buyer. So beware of people who are very vague. Most investors buy what they know. They've got experience and knowledge and expertise. And again, most investors don't buy things that they know nothing about in sectors that they don't know anything about because it's too risky for them. And lastly, look them up on Companies House. Have they got any track record of buying businesses? Now, we all got to start somewhere. But again, ask the relevant questions. Are you the first company that they will have bought? How are they going to fund it? So there's three sort of things to be aware of with tire kickers. And just to finish off on the approach side, there's a really good method that stood me in good stead for the last 20 years. Phone, mail, phone. So identify first who you want to approach on your 50 plus prospects, then pick up the phone, find out who's responsible for acquisitions within that organization, and try to have a conversation with them. It might take a few attempts. Larger businesses will normally have an M&A director, so that makes it quite easier. But start at the top, start at president, CEO, and work your way through their organizational tree. Have the conversation with them. Initially, it's going to be on a no names basis because there's no NDA that's been signed yet, picking up on Rena's point from earlier. But you do want to mail out some details to them that don't give away who you are. And this is where there's an advantage if you use an M&A advisory firm. If you're doing it yourself, trying to sell your business yourself, number one, don't do it. But if you ignored my advice and do it yourself, it's very hard to pretend to be who you're not. So it's that much easier to use a third party to represent you. When you've set out that initial information on a no names basis, then pick up the phone a couple of days later with a view to booking a meeting. So anonymized teasers and then a non-disclosure agreement. Once that's back, then you can send out a sales prospectus. It's in the industry, it's called an information memoranda. And I always advise to send 3 years historical accounts as well. So that just gives you an overview as to how to approach interested parties or potential buyers that you've identified. And a reminder, do follow up. Don't expect them to. No one returns a sales call, ever. I've been in sales for 40 years. No one ever returns a sales call. You've got to take the initiative if you want to sell your business. Again, it takes time, something that Rena's mentioned. And then you book that meeting with the decision maker. Not try to get round the table or on a Zoom call with the people that can make the decisions, rather than people who are representing folk higher up in the tree. And because I've got a stylized picture there, you can see in the background of a brain. That is a brain rather than a tree. I always encourage clients over the years just have an open mind as to where their buyer is going to come from. Half the time, it's a surprise to them. So we've done the content piece between us, Rena.
Yeah,
we've got there. Now we're going to open it up for some questions. I've seen some chat questions coming in, but I will give priority to the two that I've had overnight. This is from Chris. In fact, we had Chris. If it's the same Chris, it's the one that why isn't due diligence simple? So we've got another one from Chris. What is a bimbo? Do you want me to take that one?
I think you better, Rob, because my definition is slightly different. Yeah.
I think what Chris means, it's a blend of a management buy-in and a management buyout, bimbo. And I've done one of those myself, actually, where you're selling a stake in a business and at the same time, in the same business, you're bringing in new investors. So not for the faint-hearted, I would say. Okay, question from Paul. Why isn't finding a JV partner on your list of 10 exit options? That's a really good question, Paul. That's because it's not the sale of a business. Sale of a business is usually where there's money exchanged. And often in the world that I've occupied for the last 2 decades, equity, whether it's partial or full. A JV partner would be, you can correct me on this, Rena, but there's some sort of arrangement, probably contractual, where 2 businesses agree to work together in some shape or form. Would that be right?
Exactly, yeah. JV is where you're still trying to grow the business. So you're not really exiting, you're taking on another partner, whether it's a partnership or a joint venture, but you will be bound by contractual terms called a JV agreement, a joint venture agreement, or something similar to that, which actually sets out the roles of the different parties. So you're not really exiting at all. If anything, you're bringing in a JV because you're trying to grow the business. So it's not really an exit strategy.
Actually, that would have been a simpler answer from me, wouldn't it? It's not an exit option because you're not exiting. But it could be, the JV could be a stepping stone to an eventual exit. And we all want an eventual exit, don't we, that's planned, because we'll end up, if we don't, we'll end up in the 13% of people who die in office that we've learned in this session. Next question from Samir. Surely goodwill is an asset in the business. Why avoid mentioning it? I did say that, didn't I, in the presentation? Are you an accountant, Samir? That sounds like an accountant's question. Goodwill often is talked about. I think it might even be an accounting expression or term. I'd say it's an amorphous concept. Another one of these. What is goodwill? Technically, you could say it's the difference between what the balance sheet says it's worth on net asset value and what you actually sell the business for. So it's balance sheet value, then what you might say if you sell it above balance sheet value, that bit on top could be defined as goodwill. I tend to ignore it when I've sold businesses. What is it, the goodwill? A bit like brand. Goodwill, what is that goodwill? What is goodwill to you? How does it show itself within the business that you're selling? And goodwill, hopefully none of the goodwill surrounds you, because if you're exiting, the goodwill leaves through that door with you. So anything else you'd add to that, Rena, from your perspective?
Yeah, I think goodwill is subjective as well. You could have a view of what the goodwill is, and somebody else coming in, it could be completely different, and what you value it and how somebody else values it is very, very different. So yes, goodwill is an element, but I wouldn't put too much emphasis on goodwill just because of that reason.
Yeah, I concur with that. Revert back to a couple of things I mentioned earlier. If it's goodwill, what about client retention? What's your repeat buyer rate? What's that percentage? Because that shows that you've got loyalty with your customers. What about your staff churn rate? That was another example. So they are outcomes of this amorphous subject called goodwill. Isla has asked, I don't have patents, etc., but we are pioneering in our field. Is that intellectual property, Rena?
So patent and trademarks and copyrights are all different areas of intellectual property, and depending on the business, you may or may not need all or some of them. Patent is very product specific, so an invention. Now, it's great to get it patented. There's a cost to it, but also remember, once you patent it, that's out in the domain, so everybody knows about it as well. So if you haven't got a right lawyer on board, a patent attorney to guide you, then there's nothing stopping somebody else from kind of recreating that and just tweaking it slightly, and they're not then breaching your patent. On the other hand, if it is this real great product and innovation, then you want to get it patented because a buyer will expect that. The trademark is slightly different. A trademark is where you are protecting your brand, your logo, your name, your colors, etc. So when somebody recognizes or sees your logo and brand, they can't then go and replicate that or use it, so that, and the test is that the layperson gets confused and think it's another business and not your business. That's very straightforward to do. It's more straightforward than a patent. It's also less expensive to do than a patent. So if you don't have a trademark for your business and you've got your business name and your logo and branding, you should do that immediately without delay. And then there's copyright. Copyright is slightly different, and that's where, for example, Rob's written this book, and I'm sure he'll have a C in there and he'll have copyright. So he is the owner of that content, so I can't go and plagiarize it. If I was going to rewrite it, I would have to make sure that it's very different to that, because he owns that content. So there's different areas of IP. You've just got to make sure that the right one applies to you and you've done something about it.
Brilliant, very thorough. Yeah, I do. Well, I have 6 books out, and all of them are copyrighted. And in fact, this presentation slide, if you see at the bottom of the screen, is copyrighted. But I have no problem in issuing my IP to people, in terms of providing IP to them, as long as it's protected. I've just seen with Isla, she's just qualified what she was saying. She doesn't have anything. But they are first mover in their sector. They're pioneering, so they do a lot of R&D. In the loosest sense, it's not in the commercial legal, not in the legal sense, but if you've got first mover advantage, that is an asset in its broadest sense, because you're at you're at the leading edge of the wave. And if you've sort of very fixed on R&D, if you're known for that, make sure you claim your R&D tax credits. And if you don't know who to go to, give me a shout, because I know who to put you in contact with. But yeah, it's not intellectual property in the strictest sense, but there is an advantage if you're not lagging behind. You're not 5 years behind other market movers and disruptors in your sector. So good question, that. Brian asked yesterday, I think, yeah. Oh, Brian's the one who asked, do both of us work on commission only? So we've got another one from Brian today. I can't come up with 50 potential buyers for my business. What can I do? Brian, very easily, come to me. I know who can. Next question. From Samir again. Are you sure you're not an accountant? I've heard you can buy a business for £1. Is that true? Maybe he's an accountant that's looking to buy an accountancy firm for £1. I'll bring you in a moment, Rena. Yeah, in theory, yes. I've heard anecdotally people doing it. I'm in the process of buying a business myself. I'm not buying it for £1. It's not just what you pay on day one. You might pick up some of the financial liabilities if you're buying a business cheaply, like payroll this month. If it's a distressed business that's got difficulties making ends meet, you may have to dip into your pocket for payroll. Or there might be some key supplier contracts that haven't been paid. So you may be picking up all sorts of debt, liabilities, responsibilities. So it's not just what you pay on day one. Rita, any thoughts on that? Sort of the no money down, you know, the buyer really isn't putting any cash into it.
I know it is advertised. I've never acted for a buyer or seller where there's only a £1 consideration. Not to say that it can't happen, it doesn't happen. And I suppose it can I suppose the way it can be done is where it's not your own money. You've got investors or bank or lending, etc. But as Rob said, you're buying it, but then, you know, day one, once you take over, what are all the other costs you're going to have to come up with? I mean, is there going to be, I doubt that they're going to have any sort of working capital in the business to say, here you go, here's £1 plus more, you know, to carry on running the business. And so you've got to be quite careful with that. You know, if something sounds too good to be true, it usually is.
Yeah, just as a personal, I've been on 2 courses about how to buy a business with no money down. And actually, in fact, they were run by the same person. You know who you are, Jonathan. I found it really helpful, actually, again, it's putting yourself in the shoes of the other people, the other side of the table. I thought it was very helpful, actually, listening. There was some tips I picked up. I went on them because I was looking to buy businesses. So I received the training. I also think it's, having been through a couple of courses, if someone comes away thinking they can buy a business for £1, they've not listened to what's been said. You can buy businesses with a limited or a smaller amount of cash on completion and the rest deferred, earn out, whatever. You can do that, but you need to know what you're doing. And it's not for the faint-hearted again. It's not easy, because every seller I've ever met in the last 2 decades wants a premium price. Even when they've got a business that's struggling, they still want their magic million, even though the business is not worth it. So it is possible, and people are getting, you know, where a buyer might get a bargain is where the seller is not represented, because they don't know. I mentioned yesterday, didn't I, about it's like dancing with a professional dance person. If you don't know the steps, if you've never done that dance before, it's going to be very obvious who's in control of that dancing partnership. And it ain't going to be you, it's going to be the buyer. So do get yourself represented. If you don't know who to go to, again, come to me. I can put you in touch with someone are a company that have done a cracking job for many, many years. Last, because I'm mindful of time, people's time. Last final question for us both from Christine. Why do you need 3 years accounts to sell a business? They're not buying the past, surely. I'll put the emphasis on that. I'm sure that's right. Correct. They're not buying. They're buying the future. You're right. Trouble is that they've got to have some idea of financial track record, sustainable earnings. I mentioned that earlier. No one values a business on one point in time for the financials. They're looking for a trend, and they're looking ideally 3 years, current year's forecast. So make sure you do management accounts. If you don't do management accounts, get your accountant to provide them for you. It'd be very difficult for you to sell your business without them. And then any buyer is going to look for next 2 years, maybe 3 year projections from you. You've got to be able to describe in numbers how you see the business growing. And yes, a past track record. I sound like an IFA, don't I? But I'm not. I used to be. Past track record is no guarantee for the future, but it gives an idea to an interested party whether you're good at forecasting or not. And what the track. And I'll give you a top tip with buyers. If the accounts in the past don't look that good, the numbers have gone south, of course they're going to want to use those because they're going to do an average of your turnover and profit. So why wouldn't they want to pick numbers that aren't too complementary from your track record as well? So you need to know how to counter that. Anything you would add on that? That's our final question, but anything else that you'd want to talk to on that part about accounts, Rena?
Yeah, I think I'd just add that put yourself into the shoes of the buyer. If you were buying, I appreciate you're not buying the history, but you'd want to know what the business has been doing. And that's, that's not in any way an indication of where the business is going. It could be better or worse, but you'd want to know. So just put yourself in the shoes of the buyer.
Brilliant. Top advice there. Okay, let me just flick through. Our time is up, Rena. It does. It
goes too quickly. I think we have to have it longer, Rob, next time.
When I watch Arsenal at the Emirates Stadium, because I'm a gooner, often an hour seems a very long period of time watching the Arsenal. But in your company and talking about what we do, it just rattled by. We have got our final episode in our trilogy. So do make sure that you log on to that. And once again, Rena, thank you for your time and insights, and see you again at the next session.
See you. Thank you. See everyone tomorrow.